Great. So once again, welcome you all to today's section. We're going to look at the interpretation of the financial statement. Good. Then right from there, we pick a 4 question to write a report on that. Good. So to continue where we ended last section, we ended at the introduction. Yes, we look at the introduction of your ratio. We said that the format or the style is very important. So you have to listen to or watch carefully the form of the report. If it is reports, one, two, memo, three, if it is briefing paper, then four, explanatory notes. So your question will take form of one of that. We've looked at the introduction, address, both the writer and then the recipient. What we look at it was for report. The basic difference between the report and a memo is that with a memo, you will start from this, and then the two. This is a memo. Then your dates, and then the subject. So this is a memo. Memo. Then what about report? Report will be, in fact, just the first two sections. You just have to interchange them. You have your nice report address. So that will be two from still date, still subject. So that is the difference between report and memo. All of them you have to introduce the reader for examination purpose. No, most memo don't need introduction. Most memo in reality, but for examination purposes, whether memo or report, you have to introduce the writer. So you have to introduce that of the examiner or the reader, what you're going to write or what you're going to talk about. Good. So that is the report and then the memo. We've looked at the introduction. So a quick summary. We said that the introduction, we need 3 sentences there. First, tell us the purpose or the decision rule or the idea behind this report. Sentence number 2, tell us the type of report and then the key ratios that we are going to use in your report so that when we start deviating, we will know. So that when we start talking about different items, we will know. Good. Then the last section, tell us any limitations of your analysis. So that will be the section. Today we are going to look at the body of your report. The body of the report. Now I believe strongly that you've gone through how to calculate the ratios. All the ratios. You've gone through how to calculate them and then you are okay with it. So when you go to the body of the report, that is where I'm going to provide the actual meaning of the ratios calculated. The actual meaning of the ratios calculated. So very first one, you look at, it's a continuation of your introduction. So in the introduction, you inform the reader that you're going to talk about profitability, 2, liquidity, 3, public gearing. So these are the ratios that you mentioned in your introduction that we are going to talk about it in the sentence number 2. Good. So in the body, how do you write the body? So first, you start with your profitability. Let me write it on top here so that we have enough space. So write your profitability here. And you start talking about profitability. Here you need maximum of 3 paragraphs. Maximum of 3 paragraphs. The very first one should talk about profitability brief. So paragraph 1 talks about profitability. Paragraph 2, she talks about the very first ratio under profitability. Don't forget that you are going to select maximum of 2 when the examiner give you chance. If you are restricted, then you have to talk about what was provided by the examiner. So paragraph number 2 will talk about the first ratio that you have selected for that of the profitability. I'm just assuming that you selected the operating profit margin. Operating profit margin. So the second paragraph under the profitability will talk about operating profit margin. Then your third paragraph should talk about the next ratio, maybe B, that will be ROCE, return on capital employed. You are done with profitability. So 3 paragraphs for profitability, you are done. Please do not use the descriptive analysis like number 1, number 2, operating profit margin ROCE. No, no, no. We are writing advanced reports, so you have to use the paragraphs to distinguish our point. So anytime I want to start or I want to talk about a new item, give a paragraph. So each paragraph have to be summarized and talk about we see operating profit margin and then profitability in general. You are done with your analysis. So when you are done like this, then you write liquidity. So down there, write liquidity again and align it. So from here going liquidity, also 3 paragraphs. First paragraph to talk about liquidity in general. Second paragraph to talk about the very first ratio under liquidity. And then B, the next ratio under the liquidity. Then you are done. So basically, this is how the report will be and then the body until you go to the conclusion. So if you are going to talk about profitability, liquidity, efficiency, then each of them will have 3 paragraphs. Or if you want to talk about 4 ratios under each, then you should have 4 paragraphs or more than that. So basically, that is it. Now, for instance, you're talking about profitability. What should be in the first paragraph? What should be in the very first paragraph? If you're talking about profitability. In the very first paragraph, you are telling us the profitability, what measure, the literal meaning of profitability. So literal meaning of what? Profitability. Great. Okay, so basically that is it. So assume you are going to talk about profitability. So you start profitability. These ratios analyze or this analyze the ability of the company. So you mentioned a company, probably Diamond and Shine, or probably Sikapa Limited. The ability of Sikapa Limited to generate enough sales revenue and manage its cost to earn favorable what? Profit, which will be distributed to the owners or retained for future investment. That's profitability. You are done. Then the next paragraph, or in the same paragraph, you can tell us that the ratios that we are going to use, they are operating profit margin and ROCE will be used to analyze the profitability. Then Then you move on to that of the first ratio on the list. Please, it must be brief. Brief, like 2 sentences, you are done. Here you move on. Two maximum, 2 sentences, not more than 2. Then you come here. This is where the interpretation starts from, the operating profit margin. So if you pick each of the ratio you're going to talk about, what are the items that we have to state in there? Good. So basically, that is, so if you pick, assume that you've selected the operating profit margin, where do you start from? So first of all, these are the four items that require from you. If you pick each of the individual ratio, four items that they are required from you. Item number one, tell us, so the actual interpretation. Great. Tell us the change in the ratio. First item on the list. So change in the ratio. Has the ratio moved? That's all. Increase or decrease. So change means increase or decrease. Then you are done. So your first sentence, in your first sentence, tell us whether the ratio has moved. You are interpreting the ratios. You are telling, I use the ratio to depict the performance of the organization. So second, tell us what's the meaning of the change, the meaning, or what does the change represent? So meaning of the change. So meaning of the change. Does the change give a good indication, a good performance, or a bad performance? So what does the change represent? The meaning of the change. So the operating profit margin, if calculated it has increased. What does it represent? Does it mean that they've increased in profitability or profitability has been reduced? That is all. Number three, reason, assign reasons. Assign reasons. Reasons for the change. Why do you think the ROCE or the operating profit margin has increased over the period? What caused that increment? That good or bad? But the meaning of the change, you can write good or bad. Good or bad. Some of the ratio, when they change, it's a bad signal, or they can also move to your advantage. So, and that's the performance of the organization. Yes. The change in the ratio equates your performance because you are using your financial statement to calculate the ratios. So any change in the ratios equates your performance over the period. So the reasons. So you should know all the reasons for the movement in the ratios. So if you take operating profit margin, what could cause the increase in that ratio? ROCE, all the ratio that you've calculated, all the profitability, liquidity, activity, efficiency, gearing, or the long-term solvency. Okay. So basically, that is it. So the reason is very important. So causes of the change. What do you think will be the main cause of the good performance that you've noticed in the ratios or the bad performance? Assign reason. But here be careful that the reason that you assign, you don't state it like factual. Those that you have evidence in a question, state it factual, like gearing, gearing ratio has reduced. And you can see clearly that the loan has gone down, which has caused a decrease in the gearing ratio. For such situation, you can state factual that this is as a result of the loan repayment. But some of the reasons, you don't have evidence in the question. The question provided to you, there's no evidence. So what you do is you use these terms. to describe the reason. Something like, this could be due to, it appears, it seems like. So those that you don't have evidence in the question, in the financial statement given to you, there's no evidence for the increase or the decrease in that particular ratio, then if you want to assign reason, you can tell the examiner that this could be due to, or it seems like, it appears that the cause of this is as a result of increase in that item. Because if operating profit margin 2017 and 2000 and what 18, 2017 is 20%, here is 30%. Oh, it has increased, which represents a good performance. Yeah, done. Reason. Oh, this is as a result of, or you tell us that they've increased the selling price. Ah, are you sure that they've increased the selling price? Were you there? Which of the selling price? They've increased from where to where? Or from which value to which value? You are not there. So make a notional or ideal assumption that this could be due to an increase in what? Selling price over the period. Yes. Unless you have evidence from the financial statement given to you. And I like those evidence. And then those that are coming outside too, they're also welcome. So kindly take note when you assign the reason. Some of them, it is clear in a question. Looking at the financial statement given to you, the asset has increased. So if the asset has increased, the current asset has increased, and then the liabilities are still the same, the current liabilities, won't you have won't it have impact on the that of the current ratio and that of the quick ratio? Good. So for that one, you have evidence. So you can go ahead and tell us that this is as a result of this. That one you are sure all the reason you are telling us is in the question. Other than that, it will be different. Good. Then items number 4 that you have to tell us is the impact or recommendation. So impact or recommendation. Impact or recommendation. Impact. So if ROCE has increased, what will be the impact on the other section? What will be the impact on liquidity? Will you have impact on liquidity or profitability? Then recommendation. Normally with the recommendation, you have to recommend if you see a very bad or terrible performance, that the liquidity is very bad, then suggest a turnaround situation for them, a strategy. Oh, they could adopt this strategy and may help them to move from that situation. Good. And that's all. So if you pick each of the ratio, the 2, 2, 2, 2, 2, these are the 4 points that we have to see. Unfortunately for trend analysis, you can't have the first one. Trend analysis. You can only have this, the change for a trend analysis, rather. For intercompany comparison, the first point will not hold. Why? Because if I ask you to perform analysis of company A and B, and then the ROCE here is 30, ROCE here is 40, you can't tell me that that's what moved or changed because they are two different companies. So the change in the ratio will not apply if you are dealing with what? Intercompany comparison. So take note. So that means if you are doing intercompany comparison, you go straight forward and tell us who is doing well, who is doing better, and then you assign reason for your argument, and then you are done. Okay, so this will be the interpretation. So we will go straight and then pick one focus and do justice to it. Now, after all the key ratios, after profitability, after liquidity, after gearing, after if, right, on all the ratios that you have to talk about, then you have to now conclude. The conclusion normally depend on the requirement. Some of the requirements are decision. They have asked you to analyze these two companies and advise certain investor as to which of the company they should invest in. So in the conclusion, that's where you write it. That okay. From the above analysis, it is safer to invest in company A than company B. That's your conclusion. But where there's no decision, I want to write the conclusion. Then the conclusion, you have to tell us overall performance. So in overall, if there are two companies, who is doing well? If it is a trend analysis, has the performance improved? The overall performance, has it improved? And then that's all. You are done. Great. So that is the conclusion. And please, after the conclusion, you sign and write your name. It's a report. So don't forget to sign and write your name, your full name, at the either left corner or the right corner, any of them. So right after the report, after the conclusion, then I'll go and then sign, write your full name, James Brown. You are done. In reality, this is where you write your titles. AG, mm-hmm, AG, MD, right? CEO or finance director. Finance director. That's reality. No, by exams, you have not given position. Even if you give position, and at your full name, okay. We are done. So now let's pick our four questions to do just. Please, there was a particular section or a particular link. Okay, so there's a question here. Let me pick the question first before I move on. After the recommendation, the next is the conclusion. Yes, some of the question, if the question is a decision question, then the conclusion and the recommendation will be one. Okay. Now with the recommendation, it must be done at the individual ratio stage. So the recommendation, we have to do it at the individual ratio stage. So right after the ratio, if that ratio is very terrible, then you make a recommendation. Then after all, if you talk about all what's supposed to do or what's supposed to write about, then you go to that of the conclusion. If it's a decision, make the decision there. Good. If there's no decision in the question, then conclude by saying that the overall performance, whether it has been improved or it has gone down, or if there are two companies overall who is doing well. So that when you compare profitability, you've talked about four ratios and the guy have scored 3 out of the 4. Oh, then overall performance is doing well, although consideration has to be given to what why it's not doing well. You are done with your conclusion. Then after conclusion, you sign. Then you write your full name there. You are done with your report about the company analysis. Now, what you have to do is this. Please make sure that you know all the ratio, all the profitability ratio, increase or decrease. What will be the reason? Please increase or decrease. There is a section on that. We did a section on that. So I will upload that section to you. Then you go to that section and then you'll be fine. So all the profitability ratios. So what I want you to do is this. Profitability ratios. Increase and then decrease. Reasons. So you should have number of reasons. So number 1, number 2, number 3. So that when you go to the exams, two things will happen. Either the profitability will increase or decrease. You have your solid point available. So when you go, it is the increase. Just switch your mind, switch your mood to the increased mood and write it. It is not the exams room that you are going to now think of what could cause increase in row C or profitability. No, 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 please. That one, no. Do it now and have your point with you. I can assure you that when you go and there's profitability, two things will happen: increase or what? Decrease. You are done. So, and you go to liquidity. Then that one to increase and decrease. You should know the reason. Then you go to all the ratios for now, and we've done that. There's a section where we look through all, and then you are fine. So that we can pick our full question, and then we'll solve and then do justice to it. Good. Okay, so now let's take our time and go through each one of them and then discuss the possible causes of the increase or the decrease in them. So if I take profitability, for instance, in fact, you should know only one item, but the item that will cause an increment, the same item will also cause a decrease. Oh yes, the same item. So if I take profitability ratios, we pick the one after the other. The profitability ratios, the big five, what are they? Number 1, the gross profit margin. Gross profit margin. So if you pick gross profit margin, what could cause an increase in gross profit margin and decrease in gross profit margin? Or what could cause a change in the gross profit margin? One, increase in the selling price, changes in the selling price. So changes in selling price. So if I write increase here in the selling price, it means that it will cause an increase in gross profit margin. If there's a decrease in selling price, it also causes a decrease in gross profit margin. Or you can also write changes. Good. So that's number 1. Number 2, I will call it changes. Changes in the sales volume. Sales what? Volume. Meaning the sales quantity. Changes in the sales. Now you are selling more. Can cause your gross profit margin to also what? Increase. Then 3, changes in the sales mix. Changes in sales mix. But items are many. Changes in sales mix. Sales mix. Let's assume that you sell a lot of products, but you sell them at a constant mix. You sell, let's say, car tire, and probably car battery. So let's see, car tire, and battery. That's what you deals in. So anytime you change the mix, it will have impact on your gross profits. In some organization, they will sell more of the car, the car tire, and the car battery before selling a vehicle. So in a situation where this style changes, it will affect your gross profit too. Good. That is it. That's the sales mix. Then the fourth one, we can talk about cost of sales. Efficient control of what? Production cost. Number four, efficient control of production cost. Efficient control of production cost. Efficient control production cost. The person that can control it production cost well, your cost of sales will be reduced and hence gross profit will go up and hence your gross profit margin will increase. That is the reason. All these reasons, if there are no evidence in your question, tell us that this could be due to increase in selling price. This could be due to changes in the sales volume or sales quantity. This could be due to efficient control of production cost. Good. You are done. So these are the few items that affect what the gross profit margin. Can also talks about bulk discount. Can also talks about bulk discounts, buying discounts. You took advantage of discounts, so you are buying more. And then you can also talk about over or undervaluation of inventory. Can also cause the changes in gross profit margin. Over or undervaluation of inventory. Over or undervaluation of inventory can also cause changes in the gross profit margin. Errors can also be a factor. Then we are done. So in exams, before you go to the exams mode, just select two of these points. All these points, select just two. Let's be part of you. When you go, you calculate the gross profit margin. It has increased. Oh, thank God. This is as a result of what? Efficient, or this could be due to efficient control of what? Production cost, such as material labor by the company. That's all. That's the reason. Okay. So now I'm going to the next ratio on the list and still under profitability. Okay. Number two on the list is the operating profit margin. Operating profit margin. Now here, the central focus must be based on operating cost. So the causes will be number one, changes in operating cost. Check operating cost. Increase or decrease in operating cost. So check the operating cost. Changes in operating cost. What changes in here? Don't forget that changes means increase or decrease in operating cost. In the operating cost. Good. So if your operating cost increased over the period, it will translate into that of operating profit margin by reducing it. So check that one first. Changes, increase or decrease in operating cost. What are the examples of operating cost specifically? Example, your admin expenses, distribution cost, and other expenses, the other overheads. Number two, in fact, all the other one that we explained can be can also affect, because it's a gross profit less operating cost that will give us operating profit. So if the gross profit has been affected or reduced, then that means your operating profit will be reduced. So items that affect the gross profit can also affect what? Operating profit margin. Just that in some or in a normal situation, the items that are made up of the made up of the operating cost, they are fixed. So in critical situation, if your gross profit increases, gross profit margin increases, your operating profit margin too also increases. They are twins, they move together. Yes. With the exception of some critical situation, if your gross profit margin increases, then in a normal circumstance, your operating profit margin must also increase, except for some few critical situations. How we get it? Okay. So basically, that is it. So here, all the other items that will explain the gross profit margin. But please, to avoid repetition of point, if you have explained that point and a gross profit margin, do not repeat it here again. Not repeat it again. So here, changes in the gross profit. So here it talks about changes in the gross profit. We are done. Changes in the gross profit. So these are the two items. Changes in gross profit and then changes in operating expenses that will cause impact here. Let the central focus be here. With the exception of exceptional circumstances where something like investment, it took a lot of investment during that year. So basically that is it. So take note. Number three, exceptional item or exceptional investments where normally it takes revenue expenditure. Critical example is expansion program. That normally comes with what? Revenue expenditure. So that revenue expenditure will take a lot of profit away. Now, when it takes a lot of profit or a lot of revenue, a lot of money away, but it has not contributed to what? Revenue. Probably the revenue will start a year after. So as the initial stage, you're not getting anything from that investment, but you spend a lot on them, a lot on that investment. So it tells us that at the initial stage, it will have impact on your operating profit margin. It will go down, but that doesn't mean that you are doing bad. Good. So we are now with operating profit margin. Then we go to row C. Now the third one will be the net profit margin. Net profit margin. For the net profit margin, summarize this. So all these points over here can also be valid. So the difference between this and this is just the interest and then the tax. That will cost different. And interest and tax normally are fixed. They are fixed. So it does not normally have direct impact. So that is it. Now let's go to number 4. That's a ROCE, return on capital employed. When explaining return on capital employed, then we are done with the profitability. Good. For return on capital employed, that's a ROCE. First of all, check two items in the question. It's made up of two ratios. If you combine two ratios together, you get a ROCE. First, the operating profit margin. Operating profit margin. So let me do it this way. It is the profit before interest and tax margin versus or times the net asset turnover. Net asset turnover. So that's the ROCE. So first, check these two items. They will cause increase in the ROCE. So the majority of it depends on these two items. But basically, go to all the questions that we've solved so far, multiply the operating profit margin by the net asset turnover. It will be the same as your ROCE. So it tells you that the changes in the ROCE correspond to the changes in these two items. So if this one increase and this one too increase, automatically ROCE must also increase. If this one decreases and this one also going down, automatically ROCE must be reduced or it also decrease over the period. However, if operating profit margin decreases, but that of the asset turnover increases, that one, the one with the strongest ability will move the ROCE. If the rate at which the net asset increase is more than the rate at which the operating profit margin decreases, or the ROCE will go up. If this one too, the rate at which it decreases is more than the net asset, the ROCE will go down. That is the determinant of the ROCE. So if you want to explain ROCE very well, these two items must come to play. Or you can use the ideas or the explanation for operating profit margin and then the net asset turnover. Good. So basically, what you have to look out for are the specific issues. They are one. Great. So specifically, we'll see number one, changes in the profit margins. So changes in the profit margin. Profit margin. So tell the examiner that this we'll see has increased as a result of the increase in the profit margin. Which of the profit margin? The operating profit margin. That's all. Number two, efficient utilization of what? Assets. Efficient utilization of assets. That's all. Efficient utilization of assets. Efficient utilization of what? Assets. Three, maintenance and replacement of assets, worn-out assets. So regular or routine maintenance. Regular or routine maintenance. Good. Then you are done. So these are the reasons that you have to assign. And check whether they've issued additional shares. Additional capital that they've employed during the year. Number four, check for additional capital they've employed. Additional capital employed. Additional capital employed. Okay, you go there. Capital that you have employed. You are done. Additional capital they've employed. Whether they've issued shares during the year. Have they issued shares? Have they gone for new loan? You know, when you issue new loan notes or you secure additional debt, it will increase the capital that you've employed and hence it will reduce the return. Yes, because if you're employing more and the returns are not also increasing, relatively, oh, then the return will go down or to reduce. That is all about ROCE, and that's all we are done. So please select some of these points. Let this point be part of you. Definitely, when you go to the exams room, two things will happen. Either the ROCE will increase or the ROCE will decrease. So when it increases, just switch your mood. It's not the exam room you are going to think because it's not thinking time. We only give you 15 minutes to read and 30 minutes to work. Good. So that is it. For 3 hours to work, not 30 minutes to. Okay. Now let's continue the game. So the next ratio is the liquidity. So let's go to liquidity. Liquidity ratio. We are now profitability. Let's go to liquidity. Liquidity. Number one on the list. Current ratio. Number one. Current ratio is the current asset over the current liability. Is to 1. So increase in the current ratio could cause by 1. Increase in the current assets. If the current assets are going hold, high. So 1 increased in the current assets. You can give example. Why will your current assets increase? Why will your current asset increases? Extending a lot of credit, giving out a lot of credit, increasing the receivables. So increasing the credit period on your receivables. So increase in the credit period. Credit period of the receivables. You are done. Inventory. Increase in the inventory. Here to under or overvaluation of inventory will also be a factor. You are done. Number 2, changes in the credit terms. Credit terms offered by the suppliers. Full stop. By the suppliers can have impact in current ratio. Number 3, talk about the current liability, payable. Payable. Changes in the credit terms offered by the suppliers. So when they increase it, then that means we can buy more. We are buying more on credit. And when we buy more on credit, it will affect your liquidity position. And that's the changes in the credit terms offered by the supplier. Then here to under or overstocking. Overstocking or overvaluation of inventory can cause that. And then you are done. So when you go, just select one of these. Definitely, you are going to make a section like this. Then you put it down. You are done. It is not in the exams room that you are going to think about the causes or the reason. No. You have your reason with you. Then you put it there for the examiner. Great. So that is the issue. So we are now the current ratio. Let's go to quick or liquidity ratio. Let's go to the asset or the quick ratio, not the liquidity. Quick ratio. So quick ratio. Quick ratio. Okay, so quick ratio. Quick ratio. So number two, quick ratio. Now with quick ratio, here we are looking for how fast you can pay your suppliers. So increase or decrease will be on liquid assets. So one, check whether they've had a lot of liquid assets, changes in liquid assets, changes in the liquid asset. Number two, check the impact on inventory. Impact on inventory. Check impact on inventory. Impact on inventory. Impact on inventory. Good. So check the impact on inventory because here we exclude inventory and compare it with that of the current ratio. Number three, check the current ratio. These two guys, they are twins. If the current ratio increases over the period, current ratio increases, but the quick ratio decreases, then it's a sign of poor working capital management. Poor working capital management. So here you can put poor working capital management. Poor or efficient working capital management. Working capital management. So poor or efficient working capital management. That is the so that will be the reason for increase or decrease in quick ratio. So the current ratio reasons can also be applied here, and then you are done. And then you are done. Good. So basically, that is the end. So kindly just take one or 2 points out of this. You can't select all of them. Take one or 2 points out of this, and then you are done. And always check the asset, the financial statement given to you. If you can see any significant changes, bring it in the report. We are done. If you have evidence of any of this in a financial statement, then you are gone. Been able to identify it in the question for us. Now let's move on to efficiency or the activity ratios. Efficiency or activity ratios. Activity or efficiency ratios. There are 5 in number. Number 1 on the list. Inventory turnover days. Inventory days or inventory period. What will cause increase or decrease in inventory days? It's the same point. If you turn it upside down, it will give you the opposite. So you need to just learn one. If you go, it is an increase, just turn the point upside down. Then you are done. Okay. So inventory days. This measure how long it takes you to sell your goods. So here, there are lots of factors that could influence how long it takes you to sell your goods. Oh yes. Example include one, outdated goods or outmoded goods. Outdated goods. All of this, you don't have evidence. So kindly tell the examiner that this could be due to, because if the goods are outdated, oh, It will delay in the selling. But if the goods are recent or current, good. Number two, changes in the demand pattern or consumer behavior. Changes in demand. Now people don't like those goods again. It will take you longer time for it to sell. Now people, the youth are moving gradually, are shifting gradually from certain taste. So if you are selling those old products where demand pattern for that product have moved or shifted gradually, it means that it will affect your inventory days. You go and buy your goods, come and put it down in your shop or your warehouse. It will be there, it will be there, it will be there. Nobody will buy it. Or it will take a longer period for it to sell. Good. So basically, that is it. So changes in the demand can cause that. I can also tell us that some of the goods are capital goods. They are what? Capital goods versus consumable, you know. So let's make it capital versus what? Consumable. Consumable goods. Which of these two will take longer for you to sell? Capital goods include what? Plant and machinery, production inputs, part, components. Let's assume that you sell tractor and someone sell, let's say, food, or yes, food. Which of these two will have a long inventory days? Definitely the capital goods. So when you start the interpretation, don't go and then jump into conclusion that people are not doing well because they have a long inventory days. Have you probably asked yourself whether they are selling a tractor or they are selling high value item? High value items. Why? High value, like land, building. It's not something that you can just get that money and come and buy every day. Somebody are buying land. Every day you are buying building. No. It's once in a lifetime. Yes. So it will have a long inventory days. All this will affect your interpretation. So we are looking for students or people will tell us that this is as a result of consumable. It's a consumable goods or capital goods which normally takes longer to sell. Or even if it is consumable goods, then it's outdated. That's why the guy is not selling the goods as expected. So these are the points that we want from you. Good. Then we are done with the inventory days. Now you can also give examples. There are many. The points are many. It also talks about discount. Discount. And we are not giving them favorable terms of condition. So they are not buying the goods. Or your goods are not final. Your goods are not what? Final. Or the competition in the market is high. There are a lot of competition. There are a lot of people in the same market offering the same product. So you go and bring your own, they'll come because you guys are saturated. It takes longer before you can sell the goods. All this will be a valid point for you. We are done with inventory days. Okay. So let's quickly move on. Great. Okay, so we are continuing the game. We are done with inventory days. Number 2, let's go to receivable days. That one too, what will affect it? Increase or decrease. So what will cause you or your receivable days to increase or decrease? It takes you longer time to receive your money from the customers when they buy on credit. What will be the reason for that? It's taking you longer time. You're not paying the money on time. What's the reason? In reality, it could be due that those customers they have high bargaining power on the company. So the customers have what? High bargaining power. Good. Over the company. So the customers have what? High bargaining power. On a company, the customer can dictate on a company. That one won't pay you. Yes, good. And this could be due to a fact that the customer will have high bargaining power. One, if that customer is a key customer, maybe you have a key customers. Key. In fact, some of the customers, they account for the larger percentage of your sales. So when they walk through the shop, you have to tell the people that, please, we have emergency. You want to take a stock count. Meanwhile, you are lying on. You want to sell to your key customer. That is it. So if you are there, be honest. If you are there and someone push some goods to you, that come and buy by force, buy it you take your time and pay it when you like. Because you didn't go, you don't need it. They are forcing it on you. So that one too, you delay in payment. All this could be a factor. They can also talk about discounts. Yes, selling discount. I give them discount, prompt settlement discount. If you give them prompt settlement discount, it will reduce the receivable days because everybody wants to take advantage of the discount. So settlement discount. Settlement discount. If you give them a lot of discount, they'll pay the money on time. Oh, the money is take 20% off if you are going to pay now. Who won't do that? Oh, I'll pay now. So it will reduce the receivable days. If I'm not giving them discount, they should pay the full amount. Okay, they'll pay, but it take time. They'll drag their feet because you said they should pay everything. At least you are not ginger them to enticing them, motivate them to pay the money on time. So definitely. And then selling more on credit. If majority of your sales are on credit, it will also affect your receivable days. So credit sales. Credit sales. Credit sales. Majority of your sales are on credit. It will definitely affect that of your receivable. Good. And then that is that. Now, when you're interpreting the receivable days, here we are saying that the shorter the better. Yes, it should take you shorter period to receive your money. But too much of this is bad. Because a time will come, the customers, they want a place where they can take their time to pay small, small. But you are putting pressure on them. They will not buy from you again. You lose your sales. So take note of that. So that's the receivable days. And then your receivable days will also decreases if your product is final or monopoly. Final. Final goods. Final goods. The type of goods, perishable. Final goods. If your goods is final and then it's like you're operating in a monopoly environment, not competitive environment. In a monopoly environment, your goods is final and everybody need it and you are the only person selling. Wow. As the only driver in a village. You are the only driver in the village. You tell them before you join the vehicle, only taxi driver in the village. Before you join the vehicle, they will inspect everybody's shoe, whether does not carry mud into the vehicle. Good. So if the final goods, normally producers of final goods detect on the customers. Yes, because their goods are final, and then if it happen to be a monopoly, that one that as well is the case. They will tell you that at this day, pay the money. If you don't pay, we will not sell to you again. Yes, and that's the only source of your raw material. So definitely you'll be forced to pay because the goods is one, final, two. That's the only goods that no substitute. I can't get anywhere to buy. Oh, if there are more substitute, we boycott it. So that is it. We are down with the receivable days. Let's go to payable days. Payable days. All these points, the opposite is true for what? Payable. Number 3, payable days. With payable days, how long it takes us to pay our suppliers? Number 1, it's also box on what? Bargaining power of the suppliers. If the supplier can dictate on us, it will decrease the payable days. The supplier is forcing us, dictating on us. So suppliers bargaining power. Suppliers bargaining power. If the supplier have more influence, then it will definitely affect you. Definitely, it will force you to pay. And as usual, if the switching cost, substitutes are not available, and the product two are final, then it will still affect you. Product are final. Good. So basically, that is it. Then I'll talk about number 4. Number 4. In fact, this and the opposite is true. So all the points we explaining here can also be valid. So we can also bring the points here so we can move a bit faster. Number 4 I'll talk about is the summary of all this. I'll not talk about it again. I'll talk about net assets. Net asset turnover. If we're explaining net asset turnover, number 1, efficient utilization of assets. So number 1, efficient utilization of the assets. Number 2, the routine maintenance. Routine or regular maintenance. Routine or regular maintenance of assets. Replacement of worn out asset. Some of the organization, they wait for their asset to get spoiled up to their last day of the useful life before they will replace it. Always their vehicle, the truck, that normally transport these goods and bring money to the organization. The truck will get stuck in the middle of the road before they will now order a towing vehicle to come and tow this vehicle before they repair it. Instead of them maintaining their assets at its good and best capacity so that always this vehicle is producing, or this asset, they are producing for you. You are not doing that. Your asset turnover will reduce. So you can have a very large assets, large capital base, but your revenue is too small because they are not producing the maximum best because you're not maintaining them well. Good. So that is the asset turnover. Then you are done. Then acquisition of new asset can also affect that. Acquisition of new asset can also affect that. We are done with activity or efficiency. I'll go to Jeremy to end the show. We are done with the activity or efficiency. Now let's quickly go to Jeremy and talk about Jeremy small or efficiency. Jeremy or long-term solvency. Jeremy or long-term solvency. So let's go to Jeremy or long-term solvency. Long-term solvency. Now the first one on the list is the debt to equity or the debt to capital employed. All of them are one. They talk about the same thing. Number one, debt to equity. And number two, debt to capital employed. All of them talk about the same thing. So you just have to choose one. So what will be the causes of changes in this item? So the causes. Debt to equity. Number one, as usual, check whether they've increased the debt, whether they've what issue or repayment of debt. Issue or repayment of debt. Check whether the guys have increased their loan or they've reduced the loan or they've repay part of the loan or they've gone for additional loans. They've gone for additional. Issue means additional. So additional or repayment of what debt. It will affect your debt to equity. If you issue new debt, it will increase the debt and hence debt to equity will be what? Increased. The same thing applies to debt to capital employed. Number two, issue of shares. It being bonus shares, right issue, still the same. And three, profit or loss. Profit or what? Loss. That's the retained earnings. If your profit, you are making profit consistently, it will increase the equity in the long run. And when equity increases, debt to equity ratio reduces. That is it. Debt to equity ratio reduces. So check this one from the question. So if you make profit consistently, maybe over 5 years, you make huge profit, it will consistently increase your retained earnings and hence increase your equity. Good. Which will reduce your what? Your gearing level. I'm done with this. You quickly go to number three. That's the interest cover. Interest cover. Number one. Check the changes in your profit before interest and tax. Changes in your profit before interest and tax. So any item that affect the changes before interest and tax also affect the interest cover. Number two, check the interest itself, the interest expense, changes in the interest expense. Changes in or the interest expense. Whether the interest that they are paying has gone up. If it has gone up, it reduces the interest cover. Then you are done. Number three, check whether they've gone for additional loan or repayment of loan. Additional or repayment of loan can also have impact on what interest cover, because it will increase the interest, then and hence reducing the interest cover. So therefore, we are done with the hearing, and I'm done with all the ratios. What left is the investor ratio. But we take our first break and then come and then continue again.